Hi everyone, today's format will be slightly different. I will be sharing with you regarding about some of the happenings in the market, and I just did this webinar for 30 over people, and I think it will be good that at least I can share it online to share my information with more investors. So the first thing that we're gonna explore more on is with regards to all the Trump tariffs, what is right now happening to the market. So let's dive right in. So we have to understand what is happening right now. So we do understand that as of now, there's a lot of news on Trump tariffs, and he is slapping tariffs on the trading partners itself. And this itself, right, actually really tests the investors' matter because there's a lot of uncertainty. Especially right now, there is still news that Trump might increase tariffs, or maybe sometimes he might want to start a tariff and then he end up delaying it. So it's causing a lot of uncertainty in the market. On top of that, of course, what we would have seen is that the US stock market actually plunged on recession fears, and they actually have seen one of the worst days since 2022. So on top of that, because of the tariff issue, people are afraid that inflation might go up again. So this is further on adding oil to the fire, making the market itself fearful of what is going to happen with the tariff issues. And lastly, what we do see also, there's a lot of news on gold hitting all-time high. There's a flight to safety. Investors are investing towards safe assets such as gold. So we do have to understand what is the current market mood right now. So as of now, the fear and greed index, we are actually at extreme fear. So sentiment wise, it's not fantastic. And of course, if you have look at the US stock market, the S&P 500 year to date itself is actually dropped by 4.3%, but it is already down by 10% from the all-time high. So Trump's take itself is, when asked about what is going to happen to the US market, and basically what he say is that he do not want to predict things. And however, this does not really rule out US recession amid all the trade tariffs, which is further adding on to the negative sentiment. But we do have to go back to the fundamentals, thinking what is it that Trump really want. I think first thing first, doing tariffs, the whole idea is he's trying to boost domestic manufacturing. He wants people to make things in America rather than overseas. And this itself, generally, if it succeeded, it will lead to better job creation. Because when companies invest in US, then what happens is that they will need to create new employment, new roles that will create better jobs for people. So we also do see that he's been trying to do this. The threats of withdrawing from NATO, of course the tariffs itself, he managed to open negotiation with trading partners. And ultimately, these two ideas itself is that Trump is trying to reduce trade deficit. So as of now, I think the trading ratio with China is actually at 400 billion in terms of import, and the export to China for the US, right, is only 100 billion. So there's quite a big deficit that we are looking at right now. And doing so itself, right, he want to reduce the spending, hence to bring down the deficit. But on top of that, right, I think it's also for national security, because he does not want to depend on others. And ultimately, he's someone that is very pro a lower US dollar, so that at least in terms of the export for US itself will be cheaper, and that itself will be better for the economy. And he's also looking to lower the interest rate, because he's a firm believer of a lower interest rate itself make business activity flourish. So he's trying to get this done also. And with all the tariff news and uncertainty in the market, is really testing the US Federal Reserve patience to see if the market is really at the point of time which is weak enough that they might want to lower interest rate, which is actually this week, today itself will be the Fed meetings. So what recession data are we looking at right now? Okay, let's take a look. So generally, right, unemployment, right, tend to rise before recession. So if you look at this is actually the unemployment rate. So for unemployment rate right now, we are actually at a very healthy range at 4.1%. Okay, and when the recession hit during this period of time, which is the 2020 COVID period, you can see that unemployment rate actually shot up by quite a fair bit, and then recession happened. as of now itself, right, unemployment rate actually is still at a very low rate. So this doesn't really scream recession to us. Business activity also tend to drop before recession. So if we look at the service data, in terms of the service industry in US, what we want to look at is that as long this rating is actually higher than 50, basically what it means is that the economy in the service industry is expanding. So service data looks pretty alright. And the next part itself will be the manufacturing data. So manufacturing data, if you take a look over here, is actually also above the 50 points. So which these are actually some of the good signs. And composite PMI basically combining service and manufacturing together. What we are looking at right now is business expansion is still valid as of current data. And I do understand, of course, the data change on a month-on-month basis. Things can change. But if based on today's market, what we are looking at right now, this data doesn't really scream recession. So 2022 itself, right, inflation was at 9%, and then you see that the business activity dropped at a very drastic rate. And this was also the point of time when 2022, majority of the US counters itself went down by quite a fair bit. So looking next on the GDP trend for the United States expanded 2.5% year on year, which is good. They are still growing, and I think likelihood looking forward is generally for GDP, 2020 was the period that they actually went into this is the recession, because basically GDP is not growing and in fact is in the negative territory. As of now, everything is still on the positive end. And a GDP generally, right, hums forward unless major issues pop up in the market. And this is the point of time that you see during the COVID period that GDP really went down and recession happened. As of now, forecast data, things are still looking okay, projecting in terms of growth going ahead. So corporate margins. So margins are company earnings generally. When they have lower margins, they tend not to be able to be more resilient in a recession. So if we look at this, US corporate profit margins, right? If you look at the trend, there's a trend over here that when margin drop, the gray color line is recession. Okay, margin drop for companies, gray color recession, margin drop recession, margin drop recession, margin drop recession, margin drop recession. So you can see that the same thing happened over and over again. So this year 2003, year 2003 over here is the same thing. Then 2010, same thing. Margin drop, recession happened. Then over here itself, there's a slight margin drop, recession, and this was the COVID period. As of now, corporate margins are actually at a high, which is also another good sign, which is positive for the market. Okay, so like what I mentioned earlier, all those data are what we call lagging indicators, and lagging indicators itself can change. It might be suddenly bad data will be appearing if, let's say, there's anything drastic that happens in the market. So we need to ensure that inflation is low enough that if, let's say, those data really are bad and then a recession really happens, a low inflation itself, right, actually gives you a better cushion for market recovery. So I will dive a bit deeper to share with you what I mean. So inflation itself as of now is a very good sign. It's on the downward trend, and right now we are at a 3% in terms of inflation. The US Fed itself is trying to aim about 2.5% inflation. We are still not there yet, but the good sign itself is that at least we do see inflation is low. Okay, but why is this important? Because if, let's say, the inflation is sky high, there isn't any way that the US Federal Reserve can cut interest rate. So I'm going to use an analogy over here. So imagine this. Imagine that, let's say today a property costs, a HDB costs maybe in terms of like 2 million. So 2 million for HDB suddenly sounds like, oh, it seems like very ridiculous. And if, let's say, that is the point of time that a recession gonna occur, and there isn't anything that the central government can do to salvage this period. Because if, let's say, for example, if they are able to cut interest rate, so if they cut interest rate suddenly become very favorable at 0%, people starts to go to buy properties again, and this will cause all the houses prices to go up again, which is detrimental in terms of economy and the social effect itself. So the lower the inflation, there's more breathing room that we can see if, let's say, data turn against us and recession happens. Okay, so let's take a look at the US Fed rate. So US Federal Reserve rate right now at 4.25%, which is considered okay. But if, let's say, really a recession happen, there's still breathing space for the Fed to cut rates, which is a good sign. Okay, so why is this important? Okay, if you take a look at this turquoise line here, this turquoise line is the Fed fund rate, the effective Fed fund rate. So you would have noticed the gray line, the gray portion over here is recession. Okay, so when recession happens, generally you will see this thing happen. Interest rate drop. Okay, the Fed will actually be able to cut the interest rate and subsequent market recovers. So recession happen over here, the gray zone. Same thing. They're gonna cut interest rate, then market recovers again. So the 4.25% as of now and the low inflation makes there's a breathing space if, let's say, right, things happen like a recession. All right. Okay, so I think we dive a bit deeper to the charts to see what are the charts showing us. Okay, I'm going to introduce something called the relative strength index to you. Okay, so this relative strength index basically measures the strength of the market at that moment. So to show you whether the market is overbought or oversold. Okay, so you would have noticed the orange color dots, right, is when the relative strength index, right, touch the bottom of the line. When it touch here, right, generally this indication is the market is oversold, meaning it's cheap to buy. So if you look at this, it touches here, this is the low. It touches here, this is the low. When it touches here, this is the low. When it touches here, this is the low, and going forward is the same. All right. Okay, and if you notice over here, this is the period when it actually touches the oversold period, which is right now. Okay, and we are currently over here. Okay, so meaning, right, this indicator does not show us when is it the lowest, because like what we can see over here is that it continued to drop. All right, but it can at least guarantee you that you are never ever buying at the top. You will never ever be buying on the expensive end itself. So generally it's like you are always buying on a discount, and in the long term wise, right, even if you bought here, and subsequent market ends up here, we are still in a better position. So this indicator, right, will help to give us a guidance in terms of, are we at buying at an all-time high, or maybe is it like a discounted price. And as of now, based on this data, I think we are looking at a good price to enter for the market. Okay, based on what I'm looking right now. And another indicator that we like to use is what we call the 200-day moving average. Okay, so this red line over here is the 200-day moving average. Generally, when the market goes below this, the market tends to be very weak. Okay, if you look at this, this is the great financial crisis during the 2008 crisis. So anytime below the 200 moving day average, basically the market is pretty weak, and it's like signs of able to pick up some stocks along the way. And at the same time over here, you see when it touches and cross over, this is the period that some clients might want to buy, some clients might want to buy, some clients might want to buy here. So over here and further. And as of today itself, right, same thing. The US market actually went below the 200 days moving average. So these are signs that we are looking at discounted prices for the stock market itself. Okay, so today itself, which is Wednesday, is going to be the Fed meeting. The expectation itself, right, likely is that they will keep the interest rate flat. Okay, so they are not going to change the interest rate. So of course, if let's say there's any news that the US Federal Reserve say that they might want to cut interest rate, that would be fantastic for the market. However, if let's say that they're gonna say that it's gonna keep the interest rate flat, that would it will be within the expectation itself. And likely, I think they're gonna keep it because they are reluctant to make any move because they are waiting to see President Donald Trump economic policies to see how this thing will affect the economy. Because right now, I think we are just at the start with all the tariffs and news by Trump. So next part itself, right, is we're gonna explore a bit on the statistics of the market. Okay, I'm gonna share with you what we call the drawdown and the end of year return. Okay, so this column here is the drawdown, all right, and then this column here itself, right, is the total return at the end of the year. Okay, this is the total return. Okay, this is a 38 years data. Okay, out of this 38 years data, right, there is 7 red years, 31 green years. Okay, it gives you a 81% chance of positive years by the end of the year. So you can see some interesting statistics over here. So let's say we see that, okay, of course there are like major drawdown during the dot-com crisis, which is like year 2000, 2001, 2002. The drop itself is huge. End of year itself, right, actually they salvage a bit. The biggest drawdown is 33%, but end of the year is minus 22. But we do see things like this happening. Year 2009, drawdown 27%. That is the biggest drawdown for the year. But at the same time, right, at the end of the year, the market returned 26.5%. Looking at statistics like this, right now, year 2005, we do see the biggest drawdown of like 10% till March. All right, of course, we wouldn't know going ahead what might that be. But if let's say this year, this is one of the biggest drawdown, the odds of a green candle and a good positive return at the end of year is still highly likely based on statistics. All right, this is based on statistics. Okay, and there are always reasons to sell. And reasons to sell, like for example, during early times, like the S&P downgrades the US debt, government shutdown, Ebola virus, crude oil fall 77%, Dow drop, volatility all-time high, trade war, yield curves invert, bombing. Okay, there are always reasons to sell, but in the long run, okay, the data for this is from 2009 until 2019. Market tend to be on the upward trend, but they will never ever be on the straight line basis. So there will be like volatility in the midst of this, and the odds and the likelihood itself is always due to market expansion. Okay, so right now at 2025, market actually went up even higher since 2019, and so likelihood this 495%, right, is actually even higher as of now. Okay, enough of knowing what is happening right now. What we want to look at itself, right, is actually what's the next decade opportunity, which is also important. Because as investors, of course, we want to know about the risk, what is happening right now, but we also want to invest in the future. Okay, so just ask yourself these things. Okay, when was the last time you still read a hard copy newspaper? When was the last time you actually went to flag a taxi? Okay, when was the last time maybe you went to the ATM or even went to the bank? Okay, maybe you will still go to the ATM, but might not be that common anymore because everything can be paid by PayNow or credit card. And the more apparent thing would be, when was the last time you went to the bank? Because with digital banking, you don't really need to go to the bank. And of course, Chinese New Year card, when was the last time you sent that? And do you have any CD collections? Okay, if you have any CD collections, right, good luck to you, because I think it's very hard to get a CD player nowadays. All right. Okay, but why am I sharing all this with you? I want to walk you through on what happened during this period of time. Okay, this is the post-internet era, but internet actually started during this period, 1990. Internet became available. So if you remember, it's the 56K modem. Google was founded. Half of the US household, right, own a personal computer. Okay, this is very significant because with a computer, you can access internet. Then Facebook was launched. Global internet user reached 1 billion. Cloud computing was launched. Then Apple releases first iPhone. This is very significant also because suddenly most of us would have a smartphone. Okay, which means instead of like half of US household right now, majority of us have a computer at our hand. Okay, Instagram was launched. IBM Watson win Jeopardy. IBM Watson is kind of like the previous it's kind of like the current ChatGPT. So AI already happened during that period. This is a large language model AI program, and it actually went on this competition, which is like a quiz-like competition, and they pit Watsons with the competitors of champions of Jeopardy, and the AI actually won. Okay, But prior to that, I think in terms of AI, it's very expensive, not able to scale. But as of now, I think with ChatGPT, everybody have access to AI. Okay, Microsoft acquires Minecraft. Minecraft is interesting also because basically when they acquire this Minecraft, this is a game, but people are testing their AI agents in the game. Rather than you taking your AI program or maybe in terms of trying to test it on the real world, doing it on the testing in a game basis will actually help you to save a lot on cost and to allow your AI agents to learn. And Pokemon Go is something that is interesting because it actually uses augmented reality. Okay, 2020 right is a very significant milestone also because everybody would have understand 2019 actually accelerated right digital innovation. That is the point of time suddenly we cannot use everybody trying to do pay now, Zoom, they trying to do Lazada, Shopee, e-commerce, and people in their 50s or even 60s, they are right now okay and open to actually purchase things online. Okay, so Zoom happens, then global e-commerce happen, Microsoft integrates AI into Office, ChatGPT, and AI-driven tools right now actually becoming industry standard. Why am I sharing all this with you? Is the internet boom economic impact right is during this period. Okay, it actually helped US GDP right to shift from 9 trillion to 29 trillion in 2024, and the internet space right actually created a lot of new industries. So if you think about it, right now we have Netflix, we got Zoom, Fiverr, Uber, Grab, Spotify. All these businesses right without the internet it will not be able to they will not be able to actually appear or even sustain themselves in the first place. Okay, and e-commerce actually went from 0 to 6 trillion today. Okay, so why is this important? Imagine this, when the internet era appears and if we are able to catch on the right trend, which is majority of these companies that captured the internet era boom right is actually in the US. So if let's say based on the US market right, from 1990 until 2025, the total return for the US market with dividends reinvested is 3,554%. And that itself is an annualized of 10%. All right. And if you have invested 10,000 through these 35 years annually and you contribute $200 every single month, basically what happened is the end result is you could have become a millionaire. Okay, some people might say 1 million might not be enough in 35 years time, but if somebody gave me $1 million I wouldn't complain. All right, so this is still a very significant chunk of money and it can be done just via compounding, and the most important thing, catching on the right trend. Okay, so what's the next wave? I think this is a better question to ask ourselves. ChatGPT was launched in 30th November 2022. Okay, this is a start. And if you think about it, right now in year 2025, 30th November till now, we are at the infancy of this wave. We are not at the end of the wave that, oh, this is already ending. And if you think about it, even the internet era itself is still booming because businesses right now are still flourishing with the internet. Internet make a lot of things which is business capable of doing things with the internet itself. And the AI market size itself, right, going forward with a prediction that they are looking at is going to increase at a CAGR of 19.2% from 2025 to 2034. That itself is going to be a very significant growth, which is the same as the internet period. And if today you are going to look at the global AI leaders, these are the top 10 countries that we are looking at. Okay, the number one itself, right, this is the important part, is still United States. Regardless of how Donald Trump talk about the tariffs, doing a lot of things that is causing uncertainty in the market, there's no way that we can say that we do not want to invest in the US. Because if that is the case, basically what we are looking at is we do not have any exposure to the tech leading companies in AI, which is all located, majority of them in United States. So US itself actually leads by a wide margin. And you can see over here, Singapore, we are also part of the top 10 now, which is good. Okay, second part, China is actually in the second, falling behind. But however, the interesting part is that the China still lead in AI patenting, which they actually produce more AI related patents than the US, which is a sign of innovation, which is something that is positive and something interesting to monitor. Okay, and if you look at this, right, basically right now, all the AI related companies, ChatGPT, Microsoft, Facebook Meta, Google, Nvidia, they design the chips, then Amazon, cloud computing, all these companies are all located at the US. So now knowing in terms of what is happening in the market, what are the things that we want to look out for investing over the next decade, I think we need to tidy up fundamentals for the portfolio too. Okay, so this is a bit of tidying up. Okay, I want to share with you this idea of the mango tree theory. Okay, if let's say today you are going to, okay, if let's say today there's going to be a seed given to you, and this seed is edible and it's a mango seed. Okay, you can either eat it right now, or you can plant it and wait for 5 years and it can become a mango forest and you can have all the food in the world. But the context is you are starving right now. So if today you are starving right now, the odds of you just eating the seed away is much higher compared to you planting the seed. Okay. So if we look at this, the first thing in mind, right, is always only invest with excess funds. Okay, so excess fund is you will not be able to plant the mango tree if you are starving for the next meal. So there's gonna be excess funds kept aside, and you need to ensure that you have some dry powder, and your portfolio investment itself, right, should never ever exceed 50% of your overall cash position. This is for prudency purposes. And your emergency funds, right, you just have to ensure that you set it aside for 6 to 9 months, or some might be self-employed, you all want to set it about like 12 months basis to create a good enough buffer that you know that if let's say anything happen, at least your emergency funds are there, you will not panic sell, or in fact if you got excess funds, you can still buy into the market when the market is low. So this is the first thing that you need to take note. The second thing, always buy at a great discount, not sell at a discount. So I give you another analogy again. Imagine this, if today you got $5 million, there's a unit near MRT, a condo near MRT in Singapore, very good, small space, it dropped from Sing dollar 2 million to 1 million. If you have 5 millions, will you buy? The first context, you need to have $5 million, which go back to the rule number one, which is you need to ensure you got an excess fund and you only invest some part of the excess funds itself. Okay, so looking at all these contexts, right, if you have the money, a good property, we say near MRT, near school, you'll find that, oh, actually not bad okay can buy at 50%, even market crisis I think can buy, because you got the spare funds and you think that it's a good deal. Okay, this is a very, very good deal. But the stock market itself is very different. And when the market is at an all-time high, everybody queue for it. But however, right now, market dropped 10%. No one is really buying. Or maybe that one person, nobody really buys. Okay, but I do understand why is it so. Because for property, for Singaporeans, I think there's more information on hand that we can digest. Meaning, let's say today, if we know that the property is near the school, it's near MRT. Singapore is very small, and population is growing, and the property prices tend to go up in the long run. This help you to make the information. But however, stock market itself, right, majority of the people do not have that information to make that decision. Okay, and that's the reason why people cannot they buy low, they instead of buy low sell high, right, they buy high, they sell low. So I'm gonna give you an example how to find solid information regarding about the counters that you are investing, so that at least you got a peace of mind. I'm gonna use an example, and please take note, this is not financial advice. I'm just using this for educational purposes. Imagine this, if today, right, you're gonna invest in Microsoft, and Microsoft, right, the revenue, this blue line is the revenue, is growing on this upward trend. Imagine you got this company, this is your company. Imagine you would have been very happy. The net income and the earnings itself, very good. Also on the upward trend basis, fantastic. So if let's say of course, there are still price earning ratio, price earning growth ratio. This is a topic for another day. But if let's say based on today, if the prices is at a fair value, drop below the fair value, and you see a company, right, revenue keeps on growing, this is kind of like the MRT beside the property. It's kind of like the MRT is still beside the property, right? So if the price fall below the fair value, you will still want to buy the stock. All right. And looking at this, past 3 years revenue growth 14% per year. This is fantastic. Okay, because how many people have their salary growing at 14% per year? And future projection is subjective. Okay, it's also projected to growth continue next 3 to 5 years at 14% a year. So this is a nearly $3 trillion dollars company, revenue growing, earnings owning, and projected future growth. And with the AI story, is also helping the company forecast with a better potential and growth trajectory. Okay, so do understand this. The stock market follow earnings. So like a business like what I shared with you earlier, revenues and earning are growing. They tend to perform well in the long run. So business does well, stock eventually follows. And that is the reason when you buy into the stock market, these are some of the data, right, that you need to have on hand so that you know that, when market drop, is it something time for you to panic? Or is it something that, maybe that's discount and you should go hunting for all these major discount in the market? Okay, the third pointer itself on systematic investing. So as of today, right now, not financial advice to ask you to invest or stuff, but more of like, if let's say today you notice that, okay, right now market is on the discount, on the low side, you want to invest a lump sum. Try not to invest in tranches. Try not to invest in lump sum. That means one shot all in. But you invest in tranches split up across maybe 6 to 12 months time. This itself is meant for you to be more psychologically comfortable. Okay, because some people might not be very comfortable or buy already, continue to drop, then don't feel good. And then after that, if let's say continue to drop again, so to avoid all this, you split it across a few months. Okay, once the few months strategy is in all the funds are invested, so be it. That itself, right, to be able to sleep at night is more important than trying to time the lowest in the market, which nobody can do so. Okay. The second part itself, right, is if let's say you got long-term investment portfolio going forward, just do dollar cost average every single month, investing regularly. This will also help you to take the emotion out of the investing game. Okay. Lastly, number 4, I think it's more and more important to have a globally diversified portfolio. Okay, why is it so? Okay, I share with you some interesting data. Okay, right now we have a few major markets all over here. We do have the DAX. DAX is a German stock market. We do have the Nifty. Nifty is the India stock market. SPY is a US market. Nikkei, the Japan stock market, London stock market, and then the Hong Kong Shanghai index, Hong Kong and China market. So if you look at this is the past 5 years data. This is 5 years. Okay, this past 5 years itself for the DAX, which is the German market, actually it went above US market. India also slightly outperformed the US market. Okay, so as of now, right, I think the US market, the US tech AI play is still a story that we want to be in. But however, we cannot ignore the fact that actually there are also other markets outperforming the US market. Okay, so take a look at this. I think Europe and the European side itself, like Germans or even other countries of Europe, they are right now a bit more wary about what is happening in the US, because US with the threat of withdrawing from NATO and then the threat of tariffs, then they suddenly notice, we can't really depend on other countries for our own defenses. So we see countries like Germany, what they did is they actually increased their defense spending and they increased their spending in infrastructure. Okay, this itself, right, government pumping money into defense segment or infrastructure, right, actually it became bullish for the stock market. And which is good, because when government spend money, what happened is that the economy itself, right, will actually grow because there's more additional liquidity in the market. Okay, then second part itself, right, India right now is more of like there's a lot of potential going ahead. For India itself, they are actually out of the G20, which is the 20 major economies of the world. They themselves have the highest GDP growth rate compared to all the other remaining 20 major economies. So if we want to buy into the story of India, which is high growth rate, and they have the youngest workforce among the G20, which means likelihood is they're gonna have more and more middle income workers, which means also at a younger age, which means right higher spending. And when they have higher spending itself, right, this generally will be a good news for the economy. Okay. Then third thing itself is Japan right now is having a lot of corporate governance reforms to unlock cash from cash-rich companies. So as of now, I think Japan corporate governance right now, what they are doing is that they are asking companies to release funds rather than just hold cash. You can pay it as dividend, doing share buyback. For short-term play itself, I think these are pretty good policies for Japan to actually start creating more companies, to create more companies that reward shareholders. And this is a short-term sign of bullishness for the stock market for Japan. Okay, then London itself right now, they themselves, I think they are intending to cut interest rate. Okay, so current bank rate at 4.5, the next decision is actually on 20th March. So if the interest rate cut is coming, right, this generally is a bullish sign for the stock market itself also. And the same thing for UK, they are also investing in their own infrastructure, and that itself is also some good news for the London stock market. Okay, Hong Kong Shanghai Index, for the past 5 years itself, right, it has been pretty dismal, went up by only 5%. But the thing itself is, I think after 2020, when the COVID happened, supply chain diversification became very real. You cannot have everything made in China. Hence, companies diversified their supply chain out of China and go into other countries that benefited, like Vietnam, India. And during, I think, 2021-22, there's a clampdown by the government for Chinese government on the tech and education segment. And the clampdown itself, right, suddenly make foreign investors very afraid of what if, let's say, one day they just clamp down certain industry that they want to invest in, and then this might be it. So suddenly there's a lot of uncertainty in the market. Okay, but what happened next is the important part. Is I think this year they actually had a meeting, which is the Chinese President Xi Jinping with the entrepreneur. Okay, so you do see like Ma Yun, then Alibaba, Tencent, CEO, they were all there over at the meeting. But there's a change of tune. Basically, prior to that was common prosperity. Okay, so meaning they do not want companies becoming too large, too big, and cannot control. Okay, so they want everybody to be on equal footing. But as of now, it's very different. You take a look at this article, what they wrote. Beijing urged the entrepreneurs to show their talent, maintain competitive spirit. Okay, this is a shift of stance, totally 180-degree change, following the multi-year effort to rein the country's largest tech companies, concerned they were growing too large and powerful. This is something also bullish with regards to the China segment, because we do not want to invest in the sectors like, for example, tech. Or if let's say we know that the government don't really like the tech segment growing too aggressively, but as of now, due to the US and China tension, they themselves, I think they know that they have to step up on the game. They have to manufacture their own chip, design their own chip, and they need the tech companies itself to continue to innovate and grow so that they will be able to continue growing the economy and still be a major power going ahead. So these are some interesting things that we are looking at. Okay, so I think in summary, right? Okay, the first thing is do ensure proper cash allocation. Set aside emergency funds, maximum 50% of cash 50% of liquid cash maximum invested to make it work. Accumulate assets. Always have this mindset, how to make your money work. This will compound throughout 10, 15, 20, 30 years. Okay? But always buy at great discount. Don't panic sell and sell at the discount. It doesn't make sense. And if let's say today you got funds you want to invest, space out your investment, buy in tranches, dollar cost average. Don't one shot buying everything. Okay, and lastly, ensure your portfolio is globally diversified for peace of mind. because what is more important is that majority of investors, if investing is something that is interesting to you, you spend a lot of time investing. Of course, you might play thematic investments that is very specific that you want to go into. But for majority of the people who do not have sufficient time to go and do investment, then they just want a peace of mind. Money still can grow above inflation. Try to invest globally so that you do not have the worry of knowing, oh, so what happened if US suddenly do that, what happened if China suddenly do that. That is not worth, the peace of mind is more important rather than the few percent higher rate of return. So I think that will be all that I will be sharing with you today, and I look forward to sharing more with you in the next video. And on top of that, I do have a newsletter, and that I send a weekly newsletter regarding about money insights and investment insights. If that is something that you are interested in, do click on the link in the description to subscribe to the weekly newsletter. And of course, if today you find that this video is beneficial, do hit the like and subscribe button so that more videos like this will be recommended to you. Alright, see you in the next video. Bye bye.